Hello, everyone. I'm Robin, and really glad to be here. And I really love his energy just now. Wow. Okay, by the way, we are from Eastspring, and Eastspring is headquartered in Singapore. It's wholly owned by Prudential, right? And we view ourselves to be Asian expertise in the space of investments, right? And out of 280 billion, right, a majority of that is in Asia. And today we have very esteemed colleagues with me, Sam Bentley, as well as Jamie Tay. Put your hands together for them. Now, before we get into the serious topics like the markets, right? Maybe Sam, starting with you. What do you do in Eastspring? What's your daily? What do you do daily? And if you're not doing what you're doing today, what would you have done?
Hello? Yeah, here we go, sorry. Hi, good morning, everybody. So yeah, Robert, so what do I do daily? So my role as a client portfolio manager and leading the team here in Singapore is to really embed myself in the investment team and try and find insight and deliver insight for our clients, for our customers and potential new customers as well. So it's a really interesting sort of bridge between investments and clients. I've been here now for coming up to 18 years in Singapore at Eastspring. So I feel like I'm sort of part of the furniture now, but still enjoy it, still get a buzz out of it every day. To the question, what would I do if I wasn't at Eastspring? I hadn't sort of come down this channel. I mean, if money was no object, you'd probably find me at the bottom of the sea, studying fish and coral and things like that. I love being in the sea and diving. If money was an object, then I always think it'd be great to work with somebody like Warren Buffett in a really sort of high quality money making environment where I could be making money for clients and learning a lot as the days go by.
Thank you, Sam. Who wants to work for Warren Buffett? Anybody wants? See, wow, a lot of people want to work for Warren Buffett. Thank you. So to Jamie, so Sam has actually shared with us what you have done, what you're doing on a daily basis. Now, same question. If you're not doing what you're doing, what would you like to do or what would you have done?
I've had many ideas through my years. So when I was young, I thought I wanted to be a teacher. I think many young girls want to be teachers, right? So then I thought when I got older, maybe I want to be a photojournalist because that also seems quite cool. And then I realized that at that tender age of 8, when I wanted to be a teacher, I was actually wanting to be an influencer. Because teachers do mold the future, do shape ideas. So I was very, very progressive for the 8-year-old. Then, as I got into the investment world, I became more and more materialistic, more conscious about prices, about supply demand, and that is why we're all here, right? Because we're very conscious about pricing. Then I realized that from a supply demand point of view, maybe I want to be a handyman now. So in your house, maybe you have like a hinge or a doorknob or the light switch. It doesn't really work, but you don't want to hire the guy to come to fix your thing for $50 transportation fee. Just transportation fee, $50 just to fix the hinge. Yeah, I forget it lah. I just leave it there. And I'm also thinking, with time, there's less and less handymen because these people would fade out from the industry. But there'll be more and more demand because there'll be people like me who have no clue how to fix doorknobs. So I think maybe my next career could be a handy woman.
Thank you. Thanks for sharing a little bit of yourself. Now, maybe just kicking off, right, the more serious topics that you are here today. First question to Sam, on the topic of equities. So Sam, he oversees and represents our equities strategies, especially in regional Asia, as well as global emerging markets. So Sam, we know a lot of investors have been and still are heavily invested in US equities. So what could be some key reasons in 2026 why investors should start looking elsewhere, like Asia? Right? Or should they consider even overweighting into Asia? Sam.
Yeah, thanks, Robin. So I think this topic has been touched on earlier today, but obviously over the last maybe 5 years, the US equity market has been a fantastic place to be invested. It's performed extremely well. But as we sort of saw last year, people have started to think about rotating. People have rotated, and if you look at performance last year, you can see how Asia has really started to come into its own. If you think about it from asset pricing or valuation perspective, it's a bit like a housing market. the US is become a real prime real estate. Everybody's paying top dollar. It's priced for perfection. People expect it to continue to perform extremely well, but the pricing is so high, you're really having to pay up a lot. Whereas if you look elsewhere, look somewhere like Asia, it's like the sort of the outer rims, the sort of the suburbs, the up and coming areas. This is where there's real opportunity. Last year, US equities are up sort of 10 to 15%. Asia was up 30%. So you already seen Asia starting to perform very well. So if you're allocated into the US right now, you've got high valuations, you've got high prices, you've got very high expectations. So there's a lot that the companies there had to deliver on. Whereas you come across to Asia, you've got much more relatively attractive valuations. We've got lots more opportunity. There's growth. There's much more growth in Asia than you see in the US as well. So there's several sort of arguments to make the case for Asia, I think. And we're showing you here a slide. One of our we're talking here today more about our Asia focus strategies, and there's a couple of Asia sort of flavors, but this is really sort of emphasizing the importance of dividends in Asia. So we have our Asian Equity Income Fund that look to deliver total returns and a 6% dividend payout every year, but it's very much focused on capturing total returns from not just the price return, but the income as well. So if you look historically on this chart on the left, just really showing you how equity market performance splits between the dividend return and the price return. So you've got to pay attention to both to capture that return of the markets over time. And our strategy very much focuses on trying to capture as much of the income and the capital return and to try and deliver that over time. And you can see on the right there, Asia is a fantastic investment universe for picking those sorts of stocks. So a substantial amount more companies in Asia paying high dividends than you can find elsewhere in Europe, US, and Japan, for example. So really strong tailwinds. We've already started going, and we've got some great fundamentals to support us as well.
Great, thanks. So the macro looks pretty bright for Asia, right? And from the bottom up, I think we see opportunities because of valuation, earnings growth, right? And of course, what Sam has shared with us is not just about diversifying into Asia, but also maybe to look into the Asia dividend part of your portfolio, right? I think there was a saying, right? The real return of your stock returns is actually dividends. Anything else is a hope, right? Okay, so maybe moving forward to Jamie now, right? And on fixed income, specifically Asian bonds, both credit, local. Last year, both Asian credit as well as local currencies in Asia did about 8%. Just nice, 8%. But what are the current key factors that makes now, a good time to even consider more investing into Asian bonds instead of US bonds? And how do you see that playing, to the end of the year? Jamie.
At Eastspring Fixed Income, we adopt the FVT framework, so it's the Fundamentals, Valuation, Technicals framework. Many of you are probably very familiar with equities, but maybe not so much for bonds, so I'll elaborate a bit more. So fundamentals would be when you compare, let's say, two bank stocks, and then you look at the balance sheet, the income statement, and the non-performing loans, and what's their growth. So similarly, in bonds, we also look at the fundamentals from this perspective. So on the chart, on the first chart, you can see that is the debt to asset ratio for Asia is lower than the US. So this is a good thing. That means for Asia, the debt is healthier than in the US. So it's a great idea now to consider, if you are very heavy into US and global, to consider diversifying into Asia from a fundamental perspective. The second factor, we look at valuations. So what this means is how does Asia bonds look versus US bonds? So if you can see from the spread chart, the credit spread, so that means the risk-free rate plus the credit spread, that will give you the end returns for the bond. The credit spread for Asia is the same as the US, which means that from a valuations perspective, Asia is as attractive as the US. The third factor we look at is technicals. So technicals is, just now I mentioned, the supply-demand. If you look at the chart, in the past few years, because yields have been quite high, so many companies were hesitant to issue bonds. That means that the supply was less, but yet there are always bonds maturing every single year, every single month, such that the net supply, meaning the issuance of bonds by the company, minus what's maturing. So what is the net supply in the market, meaning kind of like the net number of handymen in the market, because some handymen retire, they mature. and then but very few handymen come into the market, right? So in the same way, there are not so many new bonds coming to the market. This means that there are positive technicals for the Asian bond markets, which is a good thing. So from a FVT, fundamentals, valuations, technicals point of view, this is all positive for Asian bonds. But what's the outcome? As an investor, we really only care about the outcome, right? So the outcome is that given all these positive tailwinds in the last few years, we have managed to bring down volatility because there was quite strong demand for this asset class. If you look at the chart, where you want to be is on the bottom right. The bottom right, which is the lower volatility, higher yield. You want higher yield, that meaning higher potential returns with less volatility. And indeed, we have our Asia Select Bond Fund, which is at the bottom right-hand corner. That's where you want to be compared to the other asset classes, for example, US or, for example, Asia High Yield. So for a bond investor, we really, really like low volatility, less volatility. And for Asia, what impacts us a lot would be China. China is huge. Everything that, that China sneezes and Asia catches a cold, right? That's what we think. And in China equities, that's done very, very well last year. So I'd like to ask Sam, given how well it's done last year, what are your thoughts for Asia equities going forward?
Yeah, thanks, Jamie. So obviously, China is an incredibly important part of the Asian equity market and Asian equity investment horizon. What we saw last year was a really solid performance from China. What we've seen in terms of valuations, what we're showing you here on the chart is that it was a very strong equity market. China didn't actually perform pretty well, but if you look on the top left-hand side here, you can see that while most markets across the world, particularly the developed markets, particularly sort of the Europe, US markets, are very expensive, China's actually still some way off its historic peaks. So it's still got some way to go from a pricing perspective. On the top right-hand side there, you can see actually also investors are still very underweight China. So there's a potential for people to increase their allocation in China. And then finally, on the bottom chart, we're just showing you the valuations of China. And you can see there that China really is quite attractively valued relative to many of the other markets. You can see the US on the far right-hand side there. So these three things tell you that, from a technical perspective, China's still pretty interesting. Now, of course, the Chinese economy, if you think about it as a table, it has a wobbly leg. We all know about the property market, and that's something that people are concerned about. But China still has growth. It still has a supportive government. It still has some really interesting areas and really interesting stocks that we can pick. Whether or not that's in the AI sort of infrastructure space, whether that's in the domestic consumption space, we still see a lot of opportunities there. So, we really think that China is offering some very interesting opportunities, and there's very much still room to run.
Thank you, Sam, for addressing the elephant in the room. I think everyone would want to know what China is doing. Now, maybe back to Jamie for a little bit on the technicals of Asian bonds. How are you seeing that technicals playing out in the US space, for example?
Yeah, good question. So we know that a lot of the growth that is driving the world right now will be due to AI. So we see a lot of US hyperscalers putting a lot of money to AI, meaning that they're hiring people, so that's thinking up for the deficit of other sectors. They are also putting a lot of money into data centers. And therefore, many of the bond issuance in the US would be driven by this. So I would ask you back, if you're comfortable with the idea of investing in hyperscalers, which everyone is in love with, right, the Mix 7, in the equity space, is that where you want to be in the bond space, where there's potentially what you expect of bonds will be more lower risk, right? That's your expectation for bonds. In equities, maybe you're okay, high risk. In bonds, you want lower risk. And therefore, we see that there's a lot more issuance in the US compared to Asia. And from a technical perspective for the US, it would not be as nice as in Asia.
Right. So what you're essentially trying to say is when you have more supply of US bonds going to the market, you tend to see the price movement on the downside. Where for Asia, because the supply is actually quite tight, right? And that's where it bodes very well in terms of your bond prices moving forward. Thank you very much. I think, yes, for Asian bonds, it has been quite underloved for some time. You could consider as a diversification in your portfolio. Now, moving, I think it's very interesting so far on China, on Asia, fixed income and equities. The other elephant in the room, to Sam, right? Or should I say Godzilla, right? How is Japan doing? It is up more than 25% in 2025. Over the past 3 years, 4 years, it has been doing exceptionally well, right? And they also welcomed their new and first female Prime Minister, Sanai Takaichi. So what are some of the potential implications of her leadership for Japanese stock market first in 2026? And how significant will these policies be driving the stock market? And as well, of course, did Abenomics do what it was supposed to do since 2012 and 2013?
Thanks, Robin. Yeah, a lot to unwind in that question. But yeah, so Japan had a fantastic year again last year. I think what we need to remember is, many people focus on Takaichi's election surprise win as being a big catalyst. But if you think about what the fundamentals, the structural improvements we've seen in Japan, actually, next slide, have really supported this longer term rally. So they're very much still in place. So whether that's the really looking at quality of corporate earnings, a lot of balance sheets in Japanese companies have been improved. There's been a big focus on corporate governance. Earnings are starting to improve. So there's lots of sort of technical, longer-term structural things that have been supportive. But also last year, we saw growth improving. We saw inflation and the reflation story improving. So there's a more optimism. And then the Takaichi election sort of was, I guess, the icing on the cake. So there really was a lot of tailwinds. Now, coming into this year, we still see some, obviously, at a headline level, Japan still looks a little, it's looking more fully valued. But if you look within Japan, what we're showing you here in the top left-hand side is the valuation breakdown of the Japanese market. And you can see that sort of 65% of it is what we would say that grey and blue bar area is still pretty attractively valued. So there's still a lot of the market that's still got value. So you need to be active. You need to be sort of stock picking in Japan. But we can definitely still find value from a bottom-up perspective. And you can see on the bottom left-hand side, the very cash-rich companies. So these companies are generating a lot of cash, doing really well. Particularly domestically now, policy-wise, Takaichi is growth-oriented. Now, some of her policies have led to the weakening yen, and now that's been something that has concerned people. I mean, we've enjoyed the weak yen if we're going on holiday there, but they don't want to see that yen continue to depreciate. So what we expect, and what I think consensus is now, is that the yen is probably going to stabilize from here, if not sort of start to move in the opposite direction over the medium term. So that's quite positive again, sort of for investing in Japan equities. You haven't got the currency headwind, and so a lot of the factors are still there, but you've got to be actively invested.
Right, so I think the key word here is being active, because you need to find the right gems from the rubles. Now, I think for Japan, if I have 3 letters to sum it, number 1, I think is the first R is reflation. We are starting to see inflation come back, right? Consumption is picking up. Wage growth is supporting that, right? And of course, from the governance side, we see a lot of reforms, in a lot of these Japanese corporates as well, right? And of course, the third R, potentially you could look at reallocating some equities, some of your capital into Japan, right? Like a lot of institutions, we also see starting to do that as well. So great, thank you. It seems like, ladies and gentlemen, on the equities front, there are many valid reasons to relook at Asia dividends, Japan, and China. Now, maybe another quick question, Sam. Right, I think the only free lunch in investment is diversification, contrary to what Mr. Kenneth has said earlier. Not contradicting what he's saying, it's just a different way of looking at it. Now, how do you think investors should position their Asian equity portfolios between style factors like income, volatility, countries, sectors, and so on?
Yeah, thanks, Rob. So we at Eastspring, we've got a range of different sort of equity products, if you like, that invest across the Asian equity region with slightly different approaches. What we're sort of focused on today is around a couple of the products. One is our Asian low volatility equity product. Now, if you had to think of sort of building a team, I think we had a football analogy earlier, so I'll use one. If you think about a football team, at the back you need to have some solid defense. You need to have a really sound sort of baseline. And if I was thinking about building my exposure to Asia, I'd like to sort of start with that solid defense. An Asian low volatility product gives you access to the upside, but it kind of tries to reduce the volatility and the bumpiness in the ride over time. May not capture all the upside. Then you have something like an Asian equity income, which is our high dividend total return product that I mentioned before. Now that also, due to its nature, due to the focus on dividends, it also reduces your volatility, reduces some of your risk, but captures much more of the upside than you might see on the Asian low vol. And then we have other products in sort of the style buckets and value and growth, and they're more like your sort of your strikers. They're the ones that can really deliver fantastic upside, but they're more likely to see volatility. So we think that you should be diversified across some of your exposures. Obviously, within each of those funds, we are being very specific about what stocks we're buying, why we're buying them, and trying to capture that total return.
Right, thank you, Sam. Now, maybe a question to the floor. Do you all like McDonald's? Do you like to eat McDonald's? Still? Still, lah? Okay. Who likes crispy fries? Put your hand. Crispy fries. Okay, a few. How about soggy fries? No? Too shy to say. Okay, anyway, what I'm trying to say is, we run quite a suite of Asian equity products. And what Sam has mentioned are two. One, Asian equity income, right? That is a dividend play, looking at how companies are looking at companies, we are looking at companies, a strategy looking at companies in dividends, whether it's dividend growth, dividend in recovery, or they're just paying dividends today, right? It's actually paying, the fund is paying about 6% per annum for what the dividend paying share class. Then, if you like the other style, right? If you like something less volatile, more defensive, right? Something that is around 20-30% less volatile than the market at different time periods, then one of the other funds that, Sam was sharing was our Asia Low Volatility Equity Fund, right? And that's something that, we look at looking at companies with good alpha upside potential, and then we screen out for the lowest volatility, right? That is also paying 6% per annum for our distribution share class. Now, thank you, Sam. That's very insightful and clear. Now, passing over to Jamie on Asian fixed income, right? And of course, that brings some good and bad memories. The question I'd like to ask is about risk, right? Everybody talks about return. How about the risk? So what are the key risks, Jamie? Should investor actively look out for, monitor, in Asian bonds? And how to mitigate this risk?
Yes, risk management is crucial for bonds because it is asymmetric, right? So, but first we need to acknowledge that the markets go up, go down. This for sure we need to acknowledge. And so I show you everyone's dream. The dream is that, sorry, Robin.
Oh, sorry.
The dream is that when markets go down, you go down less than the market. And when the markets go up, you go up more than the markets. This is everyone's dream, right? You want to manage your beta of your portfolio carefully. So just now when the MC said that there is no best fund, and I kind of agree in that case that because the best fund changes with time, so we must acknowledge that when markets go down, you want a fund with less beta, and when markets go up, you want a fund with more beta. Thank you, man, for agreeing with me. So, but then we're all busy, right? We're all our day jobs. We want to worry about where we're going for lunch, what we're going to buy for Chinese New Year. We want a manager to do it for us. That's what we want, right? That's our dream. So what our manager did, and this is really what he achieved. This is a real example of a fund. When markets went down, he was very careful. And just now, for fixed income, it's a little bit more complicated than equities because there are always three drivers: duration, credit, and FX. So I show it on the right-hand side. So what you want to do is a manager who is fully awake and alert. And so what we did beginning of last year was we were more tactical. We did the more range trading. Second half of the year, we were longer duration. So we are very non-emotional. So we don't think about the one that got away. We don't think about, I could have been a photojournalist. No, we are very unemotional. The time has passed, we move on. So we are very clear on what works, what we think is going to work going forward. It doesn't matter what happened in the past. The second item is credit. So credit, a lot of people just think, okay, are you more investment grade or more high yield? So we are a lot more granular in that. For example, we like the subordinated bonds of investment grade issuers. So your risk there is not default risk. Your risk there would be extension risk. And we think that this risk is acceptable for an investment grade issuer. The third thing we look at is cross-currency basis. For example, we may buy a Singapore dollar bond hedged to US dollar if it makes sense. Or we can buy a yen bond hedged to US dollar because there's a nice pickup. So these are various things we do. We have more levers for you. And of course, there's some obvious lever of it's Asia, many countries, many sectors. So there are a lot more parameters in bonds that we can play with to manage risk.
Thank you. So maybe the last 30 seconds, how would you, if there's one word to describe 2026, Sam and Jamie, quickly, how would you use one word to describe?
I'd probably use a word, something like compass. I think navigating this market is going to be quite a interesting year. Like I said before, I think you've got to stay invested and you've got to stay active and you've got to try and make the right decisions as you navigate the sort of the markets ahead.
And Jamie?
I would use flowers for Asian bonds because I look at all of you and you're so colorful and some of you are smiling at me like beautiful flowers. So I think flowers is a story first. Maybe I went to Jeju several years ago in January, and I went to the Botanic Gardens. And you think, wow, why would you go to the dead of winter in Korea to the Botanic Gardens? And I thought maybe like, winter sonata, the naked trees, like so romantic, right? But I went there and I saw beautiful camellias. In sharp contrast in Singapore, which is very, very hot, orchids do very well. So my point is, there are different flowers for every season. There are different Asian bonds for every season in the cycle. And therefore, this is the playground that we have. It's a huge field of flowers that we can choose from. And we're very careful not to think that this 2026 will be a bed of roses, because it will not be. Therefore, you want an active manager who's always looking out for your best interest.
Okay, thank you, Sam and Jimmy. I think we ran out of time, but thank you for sharing your thoughts and view. So for Eastspring, what we are thinking right now is think Asia and think active. And if you have more questions, please come to our booth at the back. Thank you very much.